Neal, we have a pop quiz round for you, right?
Quiz. All right.
So, are you ready for it?
I'm ready.
Okay. So, what is the primary purpose of a 1031 exchange? Is it A, to eliminate property taxes, B, to defer capital gain taxes on real estate sales, C, to reduce mortgage interest rates, D, to avoid income taxes on rental income, or E, none of the above? So, which
Well,
one?
it's a little bit B, but a little bit E. So, 1031 exchange is when you have investment real estate. It's not all real estate. It's investment real estate. And you decide that, hey, I'm going to keep this asset I'm going to keep this money in the same asset class. I'm going to keep it in real estate. Now, before Tax Cut and Jobs Act, it was more general. But then Tax Cut and Jobs Act changed 1031 to be real estate only and investment real estate only. And no, not too surprising, Trump was a real estate guy. So, it's a like kind exchange. So as long as you exchange one business asset for another business asset of a like kind, then as long as, to the degree that you don't take any money home, then that transfer is tax deferred. It's not tax free, but it's tax deferred. So, if you're a real estate person, investor, whatever, then, you have, asset A that let's just call a single family house. It appreciates, you sell it. You say, okay, I've got $1 million of capital gains. It's in a nice neighborhood, whatever. And I don't want to pay taxes on it. I still want to stay in real estate. So I'm going to roll all that money, all the proceeds into another purchase. And typically the way this works is you go up in size of the deal. So if I start off with $1 million deal, I'll put that as a down payment and I'll finance the rest. And now I'm into a $3 billion deal or a $4 million. Maybe it's a small apartment house or something. And then, time goes by, you decide to sell that one. And then you say, well, do I want to take the tax hit now or do I want to roll it again? And you can go whichever way you want on that. But typically what happens is that people who start doing 1031 exchanges have to continue it. They have to, because what happens is the cost basis of your original purpose is or your original purchase is what gets moved forward into the next asset. So let's say, we had that $1 million sale. Let's say I bought it for 500,000. Right? So now I've got $500,000 cost basis and I roll that money into a $4 million apartment house. Right. But now my cost for tax purposes is still 500,000. So now if I sell that $4 million thing, I've got a much bigger spread that I have to pay taxes on. And maybe I don't have the cash for that because I refinanced and I took the equity out and did all these things. And so, the danger with 1031s is that you can get tracked into continuing them. They work great if the plan is to follow the buy, borrow, and die strategy. You buy the assets, you borrow against them, and you keep them rolling, whether you keep the same asset or you do 1031s into other assets, and you keep it going until you die. And then your heirs get a step up in basis, and it becomes a tax-free transfer across the generations. So, that works great with 1031s. If 30 years goes by and you say, well, it's time to sell, my kids, I hate them, it's whatever, right? Then you end up with enormous tax bills at that point, because the thing you bought 30 years ago, not only was it a smaller deal, but, inflation has eroded that value away anyways. So, if you think about 30 years ago in 1995, what were real estate prices? It's like, a fraction of what they are today. Even if you were buying, at the market then, that you didn't get a special deal or whatever, that's how inflation works. So, I remember, talking to a friend of mine. So in 1995, I was 15 years old. And I remember talking to a buddy of mine and, we were talking about our houses, and really we knew nothing about our parents' financial situations, but we were making, wild guesses. And he had said that, his dad had told him that it was stupid not to have a mortgage at that particular current time with those particular, rates and things. It's a debatable position you could take, but whatever the case is, even if you financed 100% of that house 30 years ago, it was 150 grand. And now that same house is 600 grand, right? So, is that uh, so when you look over these longer time frames with these 1031 implications, the tax bill just grows because now we're looking at 600,000 against 150, even though it's the same property that it was 30 years ago. Yeah, so it's just a thing you got to deal with if you enter that game. So I would say the answer is B, but you got to restrict it to investment real estate and the things associated with that. So
Good answer. Thank you. All right.